What's up everybody, Gen X Dividend Investor here. In this enlightening video I tell you about weekly paying dividend stocks, as getting paid more frequently is something most folks appreciate. And a quick note, I had people vote if they like a slightly faster pacing in my vids or if they like it slower, and about 2/3 of the people said faster, so I'll try that for a while. But don't despair if you like a slower pace, as you can click on the gear icon in any video and then change the playback speed to whatever you want. Obviously, you could also speed things up, which is what many of you were doing, but I'd rather talk at my natural faster pace and then let a smaller number of people slow things down if they prefer. It's always a challenge to make everyone happy, and so I try to go with what the majority of people want, as long as it makes sense to me. Anyway, back to the vid. Now I understand it's alluring if a ticker pays out more frequently, but you don't want the cadence of payouts to be a big factor in why you invest in something. The reality is it shouldn't matter too much if you get paid $100 every week or $400 every 4 weeks. I mean, sure, most of us are used to getting paid every 2 weeks, so if our dividends come in like that, then it makes things slightly easier on us. But beyond that, it's not like you're really going to make more money due to slightly faster compounding. Like if you invested $10,000 at an 8% interest rate and it compounded annually, then after 10 years you'd end at $21,589. But if instead you were compounding your interest more frequently, let's say quarterly, then after 10 years you'd end at $22,080, which is only 2% more. What if you were compounding it weekly? Well, then you'd end at $22,241, or about 3% more than if it was compounding once a year. So yes, you do get a tad better return from more frequent compounding, but what really matters is if the investment is good, and a better investment will usually yield a lot more returns over a decade than one that simply pays out more frequently. Of course, the best case is a great investment that pays out frequently, but my point is to not sacrifice quality in favor of the frequency of payout. Besides, I bet if you held 20 to 30 tickers, then you'd probably randomly come close to getting paid once every week or two. Like I own 28 tickers in my dividend portfolio, and this is what my dividend payouts look like without me trying to get paid every month or week or whatever. The first column are my tickers, and then each subsequent column are months going out into the future, with the green highlighted column being the month we're currently in. I have this sorted from my largest position to my smallest, and this estimates what my next 6 months of payouts should look like, assuming I don't invest any more into my tickers and assuming there are no hikes or cuts that happen. This month my dividends will yield about $9,900, then next month they'll yield $12,700, and then $8,300 in the month after that, and then those three amounts basically repeat since most of my tickers pay quarterly, which means that my dividends pay me about $120,000 a year, nicely spread out over time. I said basically repeat because I have some variance in payout with my international tickers due to changing currency implications and due to varying amounts that my dividend ETFs pay out. And interestingly, I actually tend to get paid each week because I have 3 monthly paying ETFs that happen to pay at different parts of the month. Like I own JEPQ, and Seeking Alpha shows that it's been paying on the 6th or the 7th of each month, so basically in the first week. JEPQ is a newer ETF from JP Morgan, so it doesn't have as much history, and that usually means it's another risk factor to consider before you invest. After JEPQ, another monthly payer I own is Realty Income, which usually pays on the 15th, so that's covering the 2nd week of each month. And I own another monthly payer in Devo, which pays on the last day of each month, so that's the 4th week of each month. So just those 3 tickers randomly ended up paying me for about 3 of the 4 weeks of each month, and then my other 25 quarterly paying dividend stocks end up paying me in a way that nicely covers my payout frequency. And note I'm retired, so having a small percentage of my income coming in from covered call ETFs is a reasonable strategy, but I'd not own them if you didn't need income now, because they'll probably underperform over the long run. If I had to guess, I'd say that most people's dividend portfolio's biggest payouts will happen quarterly, probably in March, June, September, and December. Let's pretend that's true for you, and as an example, let's say you got $10,000 of dividends a year, paid out in the 3rd, 6th, 9th, and 12th months. That means you'd be getting $2,500 a quarter, or about $192 a week. So if you wanted, then after your first quarterly distribution, you could just start withdrawing $192 a week and effectively create your own weekly payer, even though all your stocks pay quarterly. That's why I recommend people invest in a basket of decent tickers that meet their various goals, needs, and risk tolerances, rather than focus on when something pays out. Or rather, I actually recommend most people just invest in broad market ETFs like BTI, even though I don't. Now I showed you how my portfolio randomly ended up paying me basically weekly, and I showed you how you could get paid weekly just by budgeting things from your own portfolio, but if you want an example portfolio of tickers that do pay out weekly, then this page from Dividend.com lists 12 stocks that, when put together, pay you weekly as well. So you can see it has Walmart, Kimberly-Clark, Altria, and some others, and then theoretically you'd be paid out each week, or at least very close to it. That being said, I'd not copy their portfolio nor mine, as you really want to create your own holdings aligned to your needs. Anyway, if all things are held equal and you were looking at 2 great companies that you believed in the same amount, and the only difference was just that one of them paid out at a cadence you liked more, then sure, go with that one. But another approach you could evaluate is a weekly paying ETF, and there are 2 that I'm aware of. Both are offered through a company called SoFi, which stands for Social Finance. And note, I'm not a fan of either of the weekly ETFs I'm going to tell you about, but I thought it'd still be good to share. Besides, I'm not a financial professional, and just because I want to invest in something doesn't mean you shouldn't. Okay, for reference, SoFi traces its roots back to some Stanford business students that used an alumni-funded lending model to connect recent grads with alumni in their community. SoFi expanded its financial offerings to include student loan refinancing, becoming the first company to refinance federal and private student loans, which is pretty cool as I didn't realize anyone did that. Then they continued to grow by offering other financial products such as mortgages, savings accounts, and various investment products. In 2020, they offered a dividend-like ETF that pays out weekly, called TGIF, which is a clever acronym that my international viewers might not get, and it stands for Thank God It's Friday, since that's when many people get paid and their work week is over. TGIF was launched by Terrasso Investments and is managed by Income Research and Management. I personally prefer having bigger names launch and manage my funds, like JP Morgan Chase or Goldman Sachs, or at least have managers I recognize, like Kevin Simpson with Diva. TGIF only has $14 million under management, and I'd personally rather invest in larger ETFs. I'm also not happy to see a relatively large expense ratio at 0.59%. One thing to be aware of is that TGIF holds bonds, not stocks, so it's getting interest payments rather than dividends, which also means its distributions should count as ordinary income for you, which generally means worse tax implications versus if its distributions were from qualified dividends. And disclaimer, I'm not a tax guy, so that's just my understanding of things. TGIF holds over 100 bonds across multiple industries and capital structures to help manage risk, many with target durations of less than 3 years to reduce interest rate risks relative to longer dated bonds. ETFs usually track an index to some degree, and TGIF tracks the Bloomberg Barclays 1 to 3 year credit index. Something else I don't like about TGIF is that it holds some high-yielding junk bonds, which have a greater degree of risk and are often more volatile than investment-grade bonds. The managers of TGIF look at 3 main attributes when picking their bonds, including price, structure, and credit. Looking over its top holdings, I see Ford Motor Credit at 2.34% of its portfolio, Credit Suisse at 1.5%, both of which I've heard of, but then it also holds lesser-known things like AirCap Holdings, Alrec Tech, and Alwyn Entertainment, which looks to be a UK company. Scanning through their other holdings, they also hold some assets I'm not a fan of, like mortgage REITs. It looks like TGIF mostly focuses on the financial sector, but they also have assets in other sectors. Now, the value of TGIF's investments in fixed income securities will fluctuate with changes in interest rates. Typically, a rise in interest rates causes a decline in the value of fixed income securities owned indirectly by TGIF. That also means that if rates fall, then the value of the fixed income securities should probably increase. And here's a total returns graph comparing TGIF in orange versus the SP 500 in blue. Total returns means stock appreciation plus distributions. TGIF started in 2020, and we see its total return since then is only 8%, which significantly underperforms the SP 500, which returned about 36%. Of course, it's only been a few years, so don't jump to too broad of conclusions, though it's performing as I'd expect. I mean, it's an income fund, so you'd expect it to underperform the broader market over the long run, and you'd also expect less volatility from bonds, which is what you see here. And in this case, by less volatility, I mean it'll probably go up less in bull markets and also fall less in bear markets. Income funds like TGIF generally aren't suited for people who are focused on increasing their portfolio worth. But if you're an older person in retirement and you're okay with its various trade-offs, then you might find it more compelling, though I'd recommend that you review other options like Vanguard bond funds and such. For fun, I did a quick backtest on Portfolio Visualizer to compare payouts between TGIF in blue and VTI in orange-red, and sure enough, TGIF consistently paid out more. But I'm not sure if the amounts shown here are accurate, as this says in 2022, a $10,000 TGIF portfolio in blue would have paid out $387, which is only 3.87% yield, as compared to a payout of $167 if you'd been in VTI. And it shows a fairly similar trend for 2023, but when I look on Seeking Alpha, it says TGIF's current yield is 5.24%. Right now it's paying out 9 cents per share per week, so 9 cents times 52 weeks a year means it's paying $4.68 per share per year, and since it costs $95, that would be about a 4.93% yield. But it also looks like at the end of each year they sometimes pay out a special one-time dividend, so between that and its expenses, it's probably around the 5% trailing 12-month yield that Seeking Alpha shows. In 2020, when TGIF was started, they were paying 5 cents per share per week, and they unfortunately didn't raise their distribution in 2021. But at the end of 2021, they did pay a special distribution of $1.49 per share. Moving on into 2022, near the end of the year, they increased their weekly payout to 7 cents per share per week, and again they did a special distribution of $1.27. In 2023, about mid-year, they raised their distribution to 9 cents per share per week. So I'm liking that increase over time, coupled with those special one-off payouts, which aren't guaranteed, but then again, nothing in investing is guaranteed. Something you might be wondering is how TGIF is paying distributions weekly, since most bonds only pay interest every 6 months. Well, what they do is accumulate any payments that come in and they add them to the fund's assets. Then they set a specific per-share distribution amount to be paid weekly, which comes out of the fund's net asset base. Thus, they are effectively doing what I said about just storing up your cash from your payouts and then distributing it at whatever frequency you want, which in this case is weekly. Okay, and then the other weekly paying ETF that SoFi is offering is ticker WKLY or weekly, which is also a great name for a ticker. This one has a 0.49% expense ratio, so it's also quite high. It only has about 10 million under management, so too small for my blood. Weekly tracks a SoFi index called the SoFi Sustainable Dividend Index. One thing I do like about Weekly is that it holds a few hundred dividend stocks rather than bonds, and the management team picks stocks that have at least maintained their dividend payments over the last year and are forecasted to continue paying them over the next year. I'd personally rather see them have a higher bar for their dividend stocks, like ones that at least have a decade of continually increasing dividend payments. If we look at the weekly holdings, we see decent companies, including multiple I own like ExxonMobil at 3.5% of the portfolio, then J&J at 3.5%, etc. You can also see that it holds some international dividend companies like Nestle's and Roche. It looks like they withhold some of your dividend payout for international dividend taxes, so I'm not sure if you could file a special form to claw back part of that withheld cash at tax time. Weekly also holds some REITs, so probably at the end of the year they'd need to supply you with a form that shows how much of the distribution is from qualified dividends versus ordinary income versus etc. Anyway, I do like the fact that you gain more international exposure with this ETF. If we look at their sector allocation, we see a decent distribution, with financials being the largest holding at about 25% of weekly, and then consumer non-cyclicals at 23%, and then energy at 13%, etc. We also see that about 56% of the dividend companies it holds are in the US, followed by 8% in Japan, 6% in Canada, 4% in France, etc. Weekly has a 3.2% trailing 12-month yield per Seeking Alpha. One thing I don't like is that since it came out in 2021, it paid the same 2 cents per share per week distribution, though in 2022 it did pay a special distribution of 47 cents per share. If we look at Seeking Alpha's Total Returns tab, we see Weekly in orange, and since its inception in 2021, it's only returned about 0.69%, which significantly underperforms the S&P 500 in blue, which returned about 15%. So like every investment, there are always pros, cons, risks, and issues. Higher yield stuff often means higher risk, and higher risk can also come from assets the ETF holds, like the junk bonds in TGIF. And in both ETFs, the weekly payout is part of what has caused the managers to charge a higher expense ratio. My bottom line is that I prefer to create a diverse basket of quality dividend companies aligned to my needs. If I want more income, then I can make that happen. If I want more dividend growth, then again I have the flexibility to change my tickers to enable that goal. But whatever you do, please show me your support by hitting that thumbs up button, subscribing if you haven't yet, and clicking that bell notification. Also, please leave me a comment telling me if you own or plan to own either TGIF or Weekly, or why not, and tell me what months your biggest dividend payouts are. And I'd normally end things by telling you who my latest new Patreon Aristocrats and Kings signups are, but I'm still all sold out of those upper tier slots. But I do have champion seats you can sign up to, which gives you some perks in my Dividend Discord. What I will do is take a moment to recognize my all-star Patreons with a shout out, i.e. those supporters that sign up or have been signed up for a year or more and that continue to stay on board. First, I'll show you my longtime Patreon Kings, which are my highest tier of Patreon supporters. Then I'll show you my longtime Patreon Aristocrats. And finally, I'll show you my All-Star Patreon Champions. Thanks, folks. I really appreciate your long-term support. Finally, I'd like to announce that Seeking Alpha has a 2-week sale starting November 23rd at 9 a.m., offering their premium service at 30% off their normal amount for new user signups using my affiliate link in the description of this video. I pitched Seeking Alpha because I value their stock articles and associated comments so much, and I'd literally never buy or sell a stock without first seeing what Seeking Alpha had on it. I paid for Seeking Alpha and used it before they ever approached me to sponsor them like they do now. Oh, and I highly recommend that you join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 76 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.